Recent reports from Bloomberg claim that Zillow is going to be selling over 7,000 homes after the company announced in their quarterly earnings call that they will be getting out of the house flipping business. Many of those houses are in Houston and Miami and some other big cities, and you might think that selling this many homes in a short period of time will surely crash the real estate markets, at least in those areas. But it might not, so we need to look into it. Maybe even more interesting, though, is the reason that Zillow cited for getting out of the house flipping business. After doing it for 2 years, they concluded that that business activity was giving them a lower return on their equity than they had originally anticipated. It sounds like the CFO didn't do a great job making the financial projections for that business unit. Or maybe the CFO just couldn't have predicted the crazy real estate market that we're seeing today 2 years ago when Zillow started to get into the house flipping business, so maybe we'll cut him a break. Since Zillow specifically listed the return on equity as the primary concern here, we're going to approach this issue like an analyst would. We'll get into what that return on equity calculation may have been, what Zillow's current ROE is, and review what may have started to go wrong with their projections when housing prices became more volatile. We're going to cover both qualitative and quantitative information to get the whole picture, so let's start with the background. And if you want to guarantee yourself superior real estate returns in the future, don't forget to click the like button on this video here. Thanks a lot. So Zillow is trying to offload about $2.8 billion worth of houses that it had originally purchased with the intent on selling them to developers and homeowners. This report comes not too long after a different report showed that Zillow had to stop their real estate buying activity when it found itself with way too much inventory after telling some of its investors on the Q2 earnings call that it was going to be ramping up its real estate flipping business. So this quarter, when Zillow announced that they had to end that business unit, they said they'll have to write down somewhere around $500 million because of the loss on these homes. Maybe more disturbingly is that Zillow will be laying off about 25% of its total workforce since they really won't have their house flipping unit or their iBuying unit anymore. It became clear to Zillow that it had underestimated how difficult the house flipping market could be. Now I'm going to read the quick quote that I think was really interesting since they pointed to their return on equity as the primary issue here. The CEO of Zillow said during the earnings call, "We have determined the large scale would require too much equity capital, create too much volatility in our earnings and balance sheet, and ultimately result in a far lower return on equity than we had imagined." Later in the week, when the CEO appeared on CNBC to discuss this topic, specifically addressing that scale that they would have had to reach, he said that Zillow only ever got to about 10% of the volume it needed to make this type of business profitable, so they weren't even close. In fact, Zillow and almost every other iBuyer out there, which is an internet-based company that's buying physical real estate, is losing a significant amount of money across the board on every single home that it purchases on average. A study in early 2021 showed that Zillow was losing about $40,000 on every single house that it flipped. I don't even know how you could lose 40 grand on flipping a house. That's impressive, Zillow. Great job there. Sticking with the qualitative information, he also pointed to the algorithm that they used to decide on which houses to buy, which they could hopefully later sell in the very near future at a small profit, was inherently flawed. For the CEO to explicitly call out an algorithm that they were using to inform a major business decision is pretty interesting for the future of business and AI. Number one, it showed how important artificial intelligence programs can be to major executives at companies that are making important decisions. Zillow built an AI model that would look at every property in the US, examine the directionality of the real estate market, and then determine which houses they could buy to sell shortly thereafter for a small profit. The timing there is the important piece. Zillow did not want to be a real estate investor, but they said they wanted to be a real estate market maker, which implies buying and selling something in very close succession. And it's this ability to sell homes in a short period of time that the AI algorithm apparently got wrong. So the second interesting point here about AI being used to inform a major business decision is that when the algorithm is not written well and the AI doesn't do exactly what you want it to do, it can be extremely costly. And not costly just for the bottom line, in this case, costly for thousands of people who are also losing their jobs because of this. Finally, the CEO said that the system making the actual transactions, so filling out the paperwork, buying the homes, and then later selling them, just literally wasn't working right. He referenced many cases in which this automated system was selling homes shortly after buying them for less than it paid. So it was just like almost instantly recognizing a loss on many properties. And buying assets and then selling them a very short period of time later at a loss is almost never going to be a profitable business move. Now let's get into the quantitative information on Zillow's financials and the return on equity calculation that they might be referencing here, specifically with this business unit. For all the CFA candidate and charter holders here, you'd probably know that return on equity is calculated as net income divided by average shareholder equity. Net income is a pretty straightforward calculation. Shareholders' equity is equal to looking at the assets of the business, but then subtracting out all their liabilities for those assets. It's not difficult to look through Zillow's financial statements and see that in recent years, they've picked up a huge amount of assets on their book, especially compared to about 2 years ago when they started buying all these residential houses. But they've also brought on a massive amount of debt to be able to finance those purchases. Now, the cost of your debt is relatively straightforward. You can just look at the interest rate that you're paying on a lot of it and some of the other sunk costs. The cost to carry those assets, though, can be very volatile, especially when the market price of those assets is very volatile, which is what we've seen in real estate recently. You might be saying, hey AJ, real estate prices have been going up recently. Zillow should have made money on all these houses that they bought, and in some ways you're right. But remember, Zillow didn't buy a ton of houses 2 years ago and then is selling them now. They've been buying houses and then selling those same houses in very short succession for about a 2-year period. Remember, they didn't want to be a real estate investor, but rather a real estate market maker. But since they're specifically mentioning a strain on the business's return on equity, which was already negative, that clues us into the fact that these assets and these liabilities that they're using for this house flipping has become more a significant factor in the aggregate financial statements of the business than they wanted it to. Because of the pandemic, they had a lot of difficulty in making some small repairs and then selling the homes. And because of the issues with their technology systems and their artificial intelligence algorithm, they've, like I said earlier, lost about $40,000 on every single home that they've purchased, which is just crazy. And those two things are really a perfect storm. They ended up holding the assets, so they became real estate investors, which they didn't want to, and the systems they were using to make those investments were flawed, so they were all poor investments. So with an all-in return on equity of -4% now, Zillow decided that they really needed to make a change. They just cannot continue to lose money at this rate and still be around in the future. Now finally, let's talk about if this selling pressure is going to crash the real estate market. This is primarily going to be based on my personal opinion and what I've seen in the real estate market, and not so much some type of hopefully accurate forecast on housing prices. It's important to remember that Zillow selling 7,000 houses is not a big piece of the overall real estate market. So just from a supply and demand perspective, it's not like the supply is going to be shooting through the roof. When you look specifically at the Houston or Miami markets, an additional 7,000 homes will make a difference, but I don't think to the extent that those two cities or the other cities partially involved in Zillow's iBuying program are going to be drastically out of whack with market prices everywhere else in the country. So to speak to everywhere else in the country, it just does not seem like the demand for single family housing is going to drop significantly enough over the next 12 months to me to cause a significant impact in the prices. Just in the last few months, housing prices have come down a bit from their peak, I think maybe 8 to 10%. So with supply still historically low, the cost of building new homes at near all-time highs, and demand still above historical norms. Yes, primarily due to people working from home from the pandemic, but just because people are going to be able to go back to work more next year does not, in my opinion, mean that they're going to want to sell their primary residences. All those things put together are to say that I don't think housing prices will be crashing 40 or 50% like they did in 2008, even when considering Zillow's actions here and also the actions of a handful of the other major online home purchasers out there right now. It may have a short-term impact, but it doesn't seem like a major economic event to me. So again, please don't forget to like this video. It just takes you a second and it really helps the channel out. I'm also curious to know if people are interested in me doing some commentary over current events sort of related to finances like this one. And if you have any questions on what's going on here, drop me a comment down below. I appreciate all of the interactions, but as always, thanks for watching.